Shares of Wells Fargo are lower today after the bank agreed to a settlement with the Consumer Financial Protection Bureau over customer abuses related to bank accounts, mortgages, and auto loans. Now, as a result, the bank is expected to see a $3.5 billion operating loss as part of its fourth quarter overall results. So joining us now is Jason Goldberg from Barclays, who covers the bank. Jason, I wonder, the big quick picture question is, given the size and scope of this fine and this overall action by regulators, is it fair to say that Wells Fargo is finally ready to put this to bed and move on?
I think from a dollar standpoint, the company has the bulk of the fines behind it. It's going to take a $3.5 billion charge this quarter, as you alluded to. It took about a $2 billion charge last quarter tied to regulatory matters and customer redress. So from a dollar perspective, we think the bulk of the consent orders are behind it. From an operational standpoint, it still has other consent orders outstanding it needs to deal with. But over the last few years, we think it's made material progress in dealing with them.
How long does it take for a bank the size of Wells Fargo to work through the kinds of issues that it has tied to the allegations and now admission of some of these fraudulent practices that were happening with regard to account openings and everything else?
Yeah, I think certainly longer than anyone would have expected. If you think about it, one of the consent orders they resolved today went back to 2016. It's still operating under an asset cap from a consent order received from the Fed in February 2018. I think when that first came out, the prior management alluded to the fact it can get lifted by the end of 2018, early 2019. And here we are at year end 2022, and it's still in place. So it takes a long time to turn a big ship. They brought a new management team in a couple of years ago that's made meaningful progress. And we certainly think they're on that road to getting that asset cap lifted, but not quite out of the woods yet.
Jason, there was a time when some traders and investors used to look at Wells Fargo and almost put it in the same category as maybe a J.P. Morgan Chase or a Bank of America or a Citi. We know that they're not exactly alike, but how long before some investors can treat Wells Fargo as truly one of the quote-unquote big banks in America? I mean, it's the amalgamation of so many different banks already. When do investors feel as though this is really something they can say is, hey, we can say this is a big money center bank to go back to?
No, I think investors kind of get it. I think a lot of all the issues that the company has dealt with and kind of resolved were, from many years ago. I mean, if you look at the performance over the last few years in the near term, you've actually seen pretty good revenue growth, kind of an improvement in market share across the businesses they choose to compete in. They're making investment in key product lines like investment banking, like credit card. And there is a meaningful expense opportunity after significant costs over the last few years to deal with some of these regulatory matters. We do think expenses will decline on a core basis in 2022 with room for further efficiency ratio improvement into 2023. So I think, listen, the bulk of the issues are in the rearview mirror, and we do expect, improved performance, relative to peers looking out.
Over the last few years, 3-4 years, if you look at the chart of Wells Fargo during that span, you're pretty much right in the middle of a trading range right now. So if you take a look at Wells Fargo, Jason, it's a game of would you rather. Would you rather be in banks like J.P. Morgan Chase or even Bank of America and Citi that are trading at relative discounts to J.P. Morgan? Or is it going to be in Wells Fargo and others, maybe super regional banks?